Many retirees think dividend investing is the safe path, but a few common mistakes are quietly wrecking their income. These errors might seem small, but they can drain your portfolio faster than you think. And the worst part? Most people don't even realize they're making them. I'll show you exactly what to fix, what to watch for, and how to build a smarter, safer income stream without starting from scratch. Mistake number 1. Starting Social Security. Too early. Most retirees think grabbing Social Security at 62 is a smart move. More checks, right? Wrong. It is one of the fastest ways to drain your retirement income. If you jump the gun at 62, you are locking in a benefit that is about 30% smaller than if you just waited until full retirement age. And that cut is permanent. But it gets even worse. If you can hold out until 70, your monthly check grows by a whopping 8% every year past your full retirement age. That could mean 24% bigger payouts for life. Think about that. Bigger, inflation-protected income when you are in your 70s, 80s, and beyond, when you will need it most. Social Security is one of the few guaranteed inflation-adjusted sources of retirement income. Every year, you get a cost-of-living boost that helps you keep up with rising prices. In a world where dividend cuts can happen and stock markets can crash, that steady, growing check is absolute gold. There is also a hidden tax bonus. If you delay Social Security and use withdrawals from your brokerage accounts first, you could stay in a lower tax bracket. That means less of your Social Security income will be taxed later. It is a powerful way to stretch your retirement dollars further. Bottom line, starting Social Security early may give you a quick cash hit, but it creates long-term pain. Waiting even a few years can unlock way more security, flexibility, and peace of mind. And speaking of long-term pain, the next mistake retirees make is chasing the wrong kinds of stocks. High-yield traps that seem good, but can wreck your portfolio. Let's break it down in the next section. Mistake number 2. Overloading on high-yield stocks. At first glance, high-yield dividend stocks look like a retiree's dream. Why not just stack up the biggest payouts you can find, right? Well, here's the truth. Chasing high yields is one of the fastest ways to wreck your retirement portfolio. First, high yield often equals high risk. If a company's dividend looks too good to be true, it probably is. Many times, a sky-high yield is not because a company is wildly profitable. It is because their stock price has collapsed. Investors have bailed, and now the dividend yield looks bigger. But it is a trap. It is called a dividend trap for a reason. You could collect a few nice checks, then watch the stock price nosedive and wipe out your gains. Even worse, companies under pressure often cut their dividends to survive. One bad announcement, and you lose your income, and your portfolio takes a double hit. There is also the danger of poor diversification. Loading up on just high-yield plays can pack your portfolio with a handful of risky sectors, like energy or real estate, leaving you vulnerable to sector crashes. And here is the kicker. Most high-yield stocks do not keep up with inflation. Sure, you might be cashing fat dividend checks today, but if your portfolio is not growing, your buying power shrinks every year. Over a 20 or 30-year retirement that can quietly destroy your lifestyle. The smart move? Focus on total return. A blend of reliable dividends and steady growth. A strong, diversified portfolio beats chasing the highest yields every time. Next up, we will talk about an even sneakier mistake. Why sticking too rigidly to a dividend-only withdrawal strategy can blow up your retirement plans. Stay tuned. Mistake number 3, lack of flexibility in withdrawal strategy. Picture this. You are living off just the dividends from your portfolio, thinking you are safe. But the market tanks, and you are still pulling out the same amount of income. That is a recipe for disaster. Here is the big problem. Relying only on dividends without adjusting your withdrawal strategy makes you a sitting duck for sequence of returns risk. That is when bad market returns early in retirement, combined with steady withdrawals, can drain your portfolio at light speed. Even if the market recovers later, it may be too late. You already spent too much too soon. And it gets worse. Inflation quietly erodes your buying power year after year. If your dividend income does not grow with inflation, you might not notice it at first. But fast forward 10 or 20 years, and suddenly you cannot cover the same expenses you used to. There is also the danger of overconcentration. Dividend-paying sectors like utilities or real estate might look steady until they are not. Without diversification, one bad sector downturn can hit you twice. First in lower income, then in capital loss. And do not forget taxes. If you blindly withdraw without a plan, you might trigger higher taxes than necessary, slicing off a bigger chunk of your income than you expected. Bottom line, a rigid dividend-only strategy is not enough. You need a flexible withdrawal plan. One that adjusts for market swings, inflation, and real-life surprises. Sometimes you will take more, sometimes less. Flexibility keeps your retirement portfolio alive and kicking. Next, we will tackle another silent killer. The mistake of focusing only on dividend income and ignoring total return. Let's get into it. Mistake number 4. Ignoring total return. Focusing solely on dividend yield might seem like a safe bet for retirees seeking steady income. However, this approach can be short-sighted. By concentrating only on the income generated through dividends, you might overlook the broader picture. Total return. Total return encompasses both the income from dividends and the capital appreciation of your investments. This holistic view is crucial for maintaining and growing your retirement portfolio. For instance, while a stock like AT&T may offer a high dividend yield, its stock price has experienced volatility, potentially eroding the value of your investment. On the other hand, companies like Apple and Johnson & Johnson have provided substantial capital appreciation over time, contributing significantly to total return. Moreover, relying solely on dividends can expose you to risks such as dividend cuts or company-specific downturns. A diversified portfolio that considers total return can help mitigate these risks by balancing income with growth potential. In summary, while dividends are an essential component of retirement income, they should not be the sole focus. Embracing a total return strategy can provide a more robust and resilient financial foundation for your retirement years. Next, we will explore another common pitfall: the dangers of becoming too conservative too soon in your investment approach. Mistake number 5. Going too conservative too soon. Many retirees believe that shifting their investments entirely into conservative assets, like bonds or cash, is the safest route. However, this approach can inadvertently expose them to significant financial risks. Inflation risk. Conservative investments often yield returns that barely outpace inflation. Over time, this erodes purchasing power, meaning your savings buy less in the future. For instance, at a modest 2% inflation rate, a portfolio generating 4 to 5% net returns could deplete 10 to 20 years earlier than expected in a 50-year retirement span. Longevity risk. With advancements in healthcare, people are living longer. A conservative portfolio may not provide the growth needed to sustain a retirement that could last 30 years or more. Being too conservative too soon can put your portfolio's longevity at risk. Missed growth opportunities. Stocks have historically offered higher returns compared to bonds or cash. By avoiding equities, retirees might miss out on potential growth that could bolster their retirement funds. Sequence of returns risk. While conservative investments aim to reduce volatility, they don't eliminate the risk of withdrawing funds during market downturns. Without adequate growth, portfolios can be more susceptible to depletion when withdrawals coincide with poor market performance. Lack of diversification. Overconcentration in conservative assets can lead to a lack of diversification, increasing vulnerability to specific economic conditions. In summary, while it's essential to manage risk in retirement, an overly conservative investment strategy can jeopardize the sustainability of your retirement funds. A balanced approach that includes a mix of growth and income-generating assets can help mitigate these risks and support a more secure financial future. Next, we'll delve into another critical concern: the impact of early market downturns combined with withdrawals, known as sequence of returns risk. Stay tuned. Mistake number 6. Ignoring sequence of returns risk. Imagine two retirees, both with identical portfolios and withdrawal plans. The only difference? The timing of their investment returns. One experiences strong market gains early in retirement, the other faces a downturn. Despite having the same average return over time, their retirement outcomes can be dramatically different. This is the essence of sequence of returns risk. It's not just about how much your investments return, but when they return it. Early negative returns, combined with regular withdrawals, can deplete your portfolio faster than anticipated, leaving less capital to benefit from future market recoveries. To mitigate this risk, consider the following strategies. Diversify your portfolio. A mix of assets can cushion against market volatility. Establish a cash reserve. Having 1 to 2 years of expenses in cash can prevent the need to sell investments during market downturns. Flexible withdrawal plans. Adjusting your withdrawals based on market performance can help preserve your portfolio. Ignoring sequence of returns risk can jeopardize your retirement security. By understanding and planning for it, you can enhance the longevity and stability of your retirement income. If you've made it this far, I've created a powerful dividend mistakes checklist just for you, and it's completely free. This guide highlights the most common traps retirees fall into, plus smart fixes and a printable checklist to help you stay on track. Just comment "mistakes" on this video. Once we hit 50 comments, I'll drop the link for everyone to download. Now that you know the biggest mistakes to avoid, let's clean house. In the next video, I'll show you which dividend stocks might be dead weight, and how firing them could boost your income and protect your portfolio. It's time to trim the fat and grow stronger returns.